Something important changed, and most people did not notice it. That is often how the largest risks arrive. They do not announce themselves with a loud headline. They do not arrive with one dramatic speech, one new law, or one clear warning. They move quietly through the system. One rule is adjusted. One compliance standard becomes stricter. One reporting pipeline becomes wider. One bank receives new guidance. One algorithm becomes more sensitive. And then one day, an ordinary person tries to move his own money and discovers that the system he thought he understood is no longer the system he is living in. That is what has happened around the old $10,000 bank reporting rule. Most Americans think they understand it. They think it is a simple rule about large cash deposits. They think it is aimed at criminals, drug traffickers, money launderers, and people carrying suitcases of cash. They think that if their money is honest and their purpose is normal, then the rule should have very little to do with them. That was never a completely safe assumption. But today it is much more dangerous than it used to be. Over the last couple of years, the rules around that threshold have become broader, faster, more automated, and more expensive to ignore. The important thing to understand is that this is not a future risk. It is not a proposal. It is not something that might happen if Washington passes another bill. It is already operating inside bank branches, inside payment apps, inside compliance departments, and inside the databases that store reports about your financial life. If you are retired or close to retirement, this matters because your financial life often becomes less predictable. At exactly the stage when the system becomes more suspicious of unusual activity. You may buy a car, you may help a child with a down payment, you may pay for medical care, you may remodel a kitchen, you may receive an insurance payout, you may sell a second home, you may move money from one account to another because you are trying to simplify your life. None of those things are criminal, but in a modern reporting system, the first question is not whether you are a criminal. The first question is whether your behavior resembles a pattern the system was trained to flag. That difference is everything. When I look at a system like this, I do not look at it emotionally. I look at it as a machine. Every machine has inputs, rules, incentives, feedback loops, and consequences. If you understand the machine, you can deal with it intelligently. If you do not understand it, you can be hurt by it even when you did nothing wrong. So I want to walk through this carefully. There are 5 changes or 5 practical shifts that have made the old $10,000 rule much worse for ordinary Americans. The first can delay access to your own money. The second can turn a pattern of smaller transactions into a serious federal problem. The third brings digital payments and crypto into the same broad reporting world that used to feel separate from normal banking. The fourth makes businesses more aggressive about reporting customers who pay them real money. And the fifth is the root cause underneath all of it, because the threshold itself has not moved with reality. But before explaining the rules, I want to begin with a simple story, because systems are easiest to understand when you see how they touch real people. Imagine a retired couple. I will call them Martin and Carol. Martin is in his early 70s. Carol is a few years younger. They live a normal, careful life. They are not speculators. They are not hiding assets. They are not moving money through offshore accounts. Martin worked for decades. Carol worked for decades. They saved, paid taxes, and lived with the kind of discipline that used to be considered the foundation of financial security. Then they decided to buy a car. They had the money. They wanted to avoid financing costs. They negotiated the price. They went to the bank to withdraw cash because in their minds that was simple. They were not thinking about federal databases. They were not thinking about suspicious activity reports. They were not thinking about elder financial exploitation guidance. They were thinking about buying a car, but the bank was not thinking the way they were thinking. The bank looked at the withdrawal through its compliance system. A senior customer who had not normally withdrawn that kind of cash was suddenly asking for a large amount. That did not fit the historical pattern. When a transaction does not fit the pattern, the system asks whether the customer may be under pressure, being scammed, or being exploited. So Martin was asked questions. Why do you need the cash? Did someone tell you to withdraw it? Have you received phone calls, emails, or text messages asking you to send money? Have you recently met anyone online from Martin's point of view? This felt insulting. He was a competent adult. He had banked there for years. He was buying his wife a car. From the bank's point of view, it was risk management. If they let a senior customer withdraw a large sum and it later turned out to be fraud, the bank could face legal and reputational consequences. If they delayed the withdrawal and nothing was wrong, the inconvenience was mostly Martin's problem. That is a classic asymmetrical incentive. When one side pays a large price for being too loose and a small price for being too strict, the system becomes stricter. Not because the people inside it are evil, because the incentives push them there. Martin eventually explained the purchase. The car dealer was real, the money was his, the purpose was normal, but the withdrawal was delayed. He had to go back to the dealership and ask them to hold the car. Later, he learned that a suspicious activity report had been filed, meaning the event was placed into a federal reporting system. That is the part most people do not understand. A suspicious activity report is not a criminal conviction. It is not proof of wrongdoing, but it is a record. It can sit in a database. It can be cross-referenced later. And when a person has more unusual transactions in the future, the old record may become part of a larger picture. This is why I say the issue is not one transaction. The issue is the pattern that a machine thinks it sees. To understand how we got here, we need to go back to the number itself. The $10,000 threshold comes from a very different world. It was created in 1970 when $10,000 meant something completely different. It was not an ordinary home repair payment. It was not a used car. It was not a medical bill. It was not a gift to help a grandchild. It was a very large sum of money. In 1970, $10,000 could represent more than a typical worker earned in a year. It could buy things that today cost many multiples of that amount. The threshold made sense because it was designed to catch transactions that were genuinely unusual in the economic reality of that time. But the problem with a number that does not adjust is that time changes the meaning of the number. Inflation is not just higher prices. It is a force that changes where rules land. If a reporting threshold remains fixed while the price of life rises, the rule quietly expands without anyone voting to expand it. It catches more people, more transactions, and more ordinary activity each year. That is what happened here. If the $10,000 threshold had been adjusted in line with the decline in the value of money, it would be much higher today, but it has not been adjusted. So the rule that once caught exceptional transactions now catches normal retirement transactions. That is the first principle when the world changes. But the rule does not. The rule becomes a different rule. In the 1970s, a $10,000 cash movement might have looked like a major warning signal. In the 2020s, it can look like a kitchen renovation, a used car, an insurance payment, a medical bill, or a family transfer. The behavior is not necessarily more suspicious. The threshold is simply older than the economy around it. That old number is now connected to modern technology. That combination is powerful. A frozen threshold by itself is a problem. A frozen threshold connected to automated reporting, digital payment platforms, bank compliance algorithms, elder fraud rules, and aggressive enforcement incentives becomes a much bigger problem. The first major change is the senior withdrawal delay. This is the one that affects retirees emotionally because it touches ownership. Most people think that if money is in their bank account, it is available to them. That is true most of the time. But in practice, banks have developed systems that can delay certain transactions when they believe a senior customer may be at risk. The reason behind the policy is understandable. Elder fraud is real. Scammers do target older people. A person can be manipulated by a romance scam, a fake emergency, a fraudulent investment, or a family member applying pressure. Banks are in a position to see some of those patterns. So regulators and state laws have encouraged them to act. But every protective system has a cost. The cost is that normal transactions can begin to look suspicious simply because they are unusual. If you normally withdraw a few $100s and suddenly request $10,000 or $20,000 or $40,000, the bank may not see a car purchase or a home repair. It may see a deviation from your pattern in a compliance machine. Deviation creates review. Review creates delay. Delay creates loss of control. The bank may not have to prove you are being scammed before slowing the process. It only needs a reasonable concern under its own procedures. And because many states provide legal protection to banks that delay suspicious senior transactions, the incentive again leans toward freezing first and explaining later. The bank is not trying to take your money. That is not the point. The point is that the system's first loyalty is not always to your convenience. Its first loyalty is to reducing its own risk and satisfying its compliance obligations. That means you must treat large transactions differently from small ones. When I think about money, I think in terms of preparation and friction. A transaction that is normal to you can create friction if it is abnormal to the bank. Your job is not to get angry at the friction. Your job is to reduce it before it appears. That leads to the second major change, the structuring trap. This is more dangerous because it is not merely a delay. It can become a legal problem. Structuring means breaking transactions into smaller pieces for the purpose of avoiding a reporting threshold. The important phrase is for the purpose of avoiding the reporting threshold. People often think that if the money is clean, then breaking it into smaller amounts is harmless. That is a very dangerous misunderstanding. The law does not only care whether the money came from a legitimate source, it also cares whether you intentionally arranged the transaction pattern to keep it under the reporting line. This creates a trap for ordinary people because many ordinary people have been taught informally to stay below thresholds. They hear that banks report transactions over $10,000. They do not understand the reporting. They do not want trouble. So they split a $12,000 transaction into two $6,000 transactions. They think they are being cautious. In reality, that can make the transaction look worse. A single $12,000 transfer may create an automatic report that you never feel. It may be routine. It may produce no practical problem at all. But 2 or 3 smaller transactions arranged to stay below the line can look like evasion. That is an important principle. Trying to avoid a harmless report can create a harmful pattern. In earlier periods, structuring enforcement often focused on obvious behavior such as repeated deposits just under $10,000. But as pattern detection becomes more advanced, the system can flag lower amounts, repeated behavior, timing patterns, and combinations of transactions that look coordinated. The machine does not know your intention. It sees shape. If the shape resembles avoidance, the transaction may be flagged. A flag may lead to human review. Human review may lead to a suspicious activity report. A report may lead to tax authorities, criminal investigators, or civil forfeiture procedures. Not every flag becomes an enforcement action. Most do not. But the key point is that innocent intent does not always protect you from the burden of proving your intent later. That is where documentation becomes critical. In life, people think truth is enough. In systems, truth without evidence is often weak. If your transaction pattern has a clean purpose, you need to be able to show the purpose. This is especially important for retirees because retirees often have irregular financial events. A pension rollover is not monthly grocery spending. A home sale is not normal checking account activity. A large gift to a child is not your usual utility bill. A medical payment may not repeat. The system sees irregularity. You must be able to explain it. The third change is the expansion of reporting into digital payment channels and crypto. Many people still make an old distinction in their minds. Cash is one thing, banks are one thing. Venmo, Zelle, PayPal, Cash App, and crypto exchanges are something else. That distinction is becoming less useful. The financial system has been moving toward broader visibility. Digital payment platforms create records. Crypto exchanges create records, payment processors create records, tax forms are issued, thresholds change, reporting systems begin to overlap. The result is that ordinary personal payments can create tax documents, and larger digital movements can become part of the same federal visibility structure that people used to associate only with bank cash transactions. This matters because the average person uses digital payments casually. A friend reimburses you. A neighbor buys something from you. A church group sends money to cover an expense. A child sends money for a family dinner. You sell a used item. You receive payment for a small side activity. Each event feels small and personal. But platforms do not understand your life story. They aggregate activity, apply thresholds, and issue forms. When thresholds fall, more normal behavior becomes reportable. The danger is not only tax owed. Sometimes there is no tax owed. A reimbursement is not the same as business income. A family repayment is not the same as profit. But if the form is issued and you do not account for it, the tax system may see a mismatch. Mismatches create letters. Letters create stress. Stress creates mistakes. So the issue is not just paying tax, it is keeping categories clean. Personal reimbursements should not be mixed casually with small business activity. Family payments should not be mixed with side income. Selling a used kayak at a loss is not the same as being paid for services. But if all of those flows move through the same account, you are asking a reporting system to understand distinctions. It was not built to understand. It will not understand them for you. You must create the separation yourself. The fourth change is the increased pressure on businesses to report large payments correctly. There is a form businesses file when they receive more than $10,000 in certain forms of payment from a customer. The form identifies the payer and the nature of the transaction. The business has the obligation, but the consequence touches you, because your information is what gets reported. This applies in practical areas of life: car dealers, contractors, attorneys, jewelers, boat dealers, real estate professionals, and other businesses that receive significant payments. As penalties for late or incorrect reporting rise, businesses become more careful. Again, incentives matter. A contractor who fails to report may face penalties. A dealer who mishandles a report may face problems. so the business becomes more likely to collect your information and file correctly. From the business's perspective, this is survival. From the customer's perspective, it can feel intrusive. The wrinkle is related transactions. If you pay part today and part next week for the same job, the system may treat the payments as one related transaction. So splitting a $12,000 roof payment into two $6,000 payments may not avoid the report. Worse, if the splitting was done to avoid the report, it may create the same structuring concern I described earlier. This is another place where people make the system harder on themselves by trying to be clever. Do not try to outsmart a reporting rule you do not fully understand. That is not risk management. That is creating a hidden liability. The fifth change is not really a new rule. It is the inflation cascade. This is the deeper force that makes everything else more dangerous. When a threshold is fixed for decades, inflation gradually transforms normal life into reportable life. The system does not need a dramatic expansion. The economy does the expansion for it. A normal retiree may have several large transactions in a single year: a car purchase, a medical bill, a home project, a family gift, a distribution, a refund, a property sale, a transfer between accounts. Each one may be legitimate. Each one may be understandable. But the reporting system does not judge normality the way a person does. It judges thresholds, patterns, categories, and deviations. That is why a person can be financially honest and still become administratively vulnerable. I want to be clear about something. The right lesson is not to panic. Panic is a bad decision-making process. The right lesson is to build principles. When a system becomes more automated, you need to become more systematic. When reporting becomes more sensitive, your documentation needs to become stronger. When banks become more cautious, your communication needs to happen earlier. When thresholds do not adjust to reality, your behavior must adjust to the thresholds. The first protection move is to notify the bank before a large transaction. This is simple, but it is powerful. Before making a large withdrawal, deposit, or transfer that is outside your normal pattern, call the branch or the bank's customer service team. Explain the purpose. Ask that a note be placed in your customer file. If you are going to buy a car, say so. If you are paying a contractor, say so. If you are helping a child, say so. If you are moving funds after a sale, say so. This does not stop required reports. It should not. Reports are part of the system. The point is not to hide. The point is to prevent unnecessary delay and confusion. A bank employee looking at a flagged transaction sees less risk when the explanation is already documented. The software may still flag the transaction, but the human review has context. Context reduces friction. This is a principle I have used in many areas of life. Bad outcomes often happen because context arrives after suspicion. You want context to arrive before suspicion. The second protection move is to stop accidental structuring. If you need to move $12,000, do not divide it into smaller pieces, simply because you heard $10,000 is a magic number. Move the amounts you need to move in a clean, honest, documented way. If a report is triggered, let the report be triggered. A routine report is often much less dangerous than a pattern that looks designed to avoid one. If there is a legitimate business reason to split payments, document that reason. Maybe a contractor requires payment at stages. Maybe a medical provider bills separately. Maybe a dealership requires a deposit before final payment. The key is purpose. The purpose should be connected to the transaction itself, not to avoiding a government threshold. This is one of the most important ideas. Do not let fear of being reported cause you to behave in a way that looks more suspicious than the original transaction. The third protection move is to use wires or direct transfers for large payments when appropriate, rather than physical cash. Cash creates special concerns. It is harder to trace. It is easier to steal. It creates handling issues for businesses. It triggers certain forms and compliance procedures. If you are buying a car, paying a contractor, or transferring a large amount to a legitimate recipient, a wire may be cleaner. It creates a record. It moves directly from one institution to another. It reduces some of the ambiguity that surrounds physical cash. Again, the point is not secrecy. The point is clarity. Systems trust clean trails more than explanations after the fact. A wire creates a cleaner trail than a paper bag of cash, even when both are legal. The fourth protection move is to separate digital payment activity by purpose. Do not make a single payment app account carry every kind of financial relationship in your life. If you receive personal reimbursements, keep them personal. If you have side income, hobby sales, or small business payments, separate them. If your family sends you money for dinners, trips, or shared expenses do not mix that casually with income, producing activity. This is not because every payment is taxable, it is because mixed categories create reporting confusion. When a form is issued, you must be able to show what the money represented. If your records are messy, you will lose time and confidence. If your categories are clean, you can respond calmly. The fifth protection move is to build a documentation habit before there is a problem. For any meaningful transaction, write down the date, the amount, the source of the funds, the recipient, and the purpose. Keep receipts, keep invoices, keep emails, keep the dealership purchase agreement, keep the contractor estimate, keep the medical bill, keep the family gift note. A simple spreadsheet may be enough, a folder may be enough, the exact format matters less than the discipline in a dispute. Memory is weak, documents are strong. Many innocent people get hurt by systems not because they cannot explain what happened, but because they cannot prove it efficiently. If you have to recreate a transaction history 2 years later, you are already at a disadvantage. If you build the record as you go, you are much stronger. There is one more advanced move that matters, especially for older account holders. Create a senior banking authorization or trusted contact arrangement with your bank. If your bank offers it, the exact name may differ. The purpose is to identify a trusted contact, describe the types of transactions that are normal for you, and give the bank a clear procedure before it delays or escalates a transaction. This can be especially useful if you expect large but normal retirement transactions, a car purchase, a home improvement, a medical expense, a family gift, a property sale, a planned transfer. If the bank already knows that these categories fit your life, a sudden transaction is less likely to look like a scam. This does not remove all review. It does not guarantee that every bank will handle every transaction perfectly, but it changes the information available to the system before the decision is made. That is how you reduce risk in complex systems. You do not fight the system emotionally, you change the inputs. Now let me bring this back to the larger lesson. The old way of thinking was simple: my money is mine, and if I am not doing anything wrong, I should not have a problem. Morally, I understand that view. Practically, it is incomplete. In the world we actually live in, financial systems are built around compliance, reporting, fraud prevention, tax matching, elder protection, money laundering controls, and algorithmic pattern detection. These systems do not know your character, they know your transactions. That means your financial freedom depends not only on owning money, but on moving money intelligently. This is particularly important later in life because retirement creates exactly the kind of transaction pattern that can confuse modern systems. Working life is often regular. A paycheck comes in, bills go out, the pattern repeats. Retirement can be irregular, assets are sold, accounts are consolidated, medical costs appear, family needs arise, one spouse dies and accounts change, a home is repaired or sold, a large gift is made, a car is bought without financing. The system may treat irregularity as risk. You must treat irregularity as something to plan for. That does not mean you should be afraid of using your money. It means you should use process before the transaction. Ask what the purpose is. Ask which payment method creates the cleanest record. Ask whether the bank should be notified. Ask whether a business will have to file a report. Ask whether splitting the payment serves a real purpose or only creates a suspicious pattern. Ask whether the digital payment will be classified correctly. Ask whether you have the documents you would want if a reviewer asked about it a year from now. Those questions are not complicated. They are principles, and principles are how you deal with a complicated world. What worries me most is not that rules exist. Rules are part of any financial system. What worries me is the gap between the rules people think they are living under and the rules that actually affect them. Many retirees learned money habits in a different era. In that era, cash was normal. Banks knew their customers personally. A large transaction happened face to face. A teller might know your family. A branch manager might understand your life. Today, even if the people at your branch are kind, the decision may be shaped by systems far above the branch. That is why being a good customer for 40 years may not be enough. A good relationship helps, but a documented relationship helps more. A clear transaction helps. A pre-notified transaction helps. A clean payment channel helps. A separated digital account helps. A written purpose helps. You do not need to become paranoid. You need to become organized. I have seen this pattern across many parts of finance and history. When pressures rise, systems centralize information. When technology improves, enforcement becomes cheaper. When thresholds remain frozen, ordinary people move closer to the lines. When institutions receive protection for being cautious, they become more cautious. None of those forces require a conspiracy. They are the natural result of incentives. The retiree who ignores incentives will be surprised by outcomes. The retiree who understands incentives can reduce the probability of bad outcomes. That is the practical way to look at this. The $10,000 rule is not just about $10,000 anymore. It is about the interaction between an old number and a modern compliance system. It is about how an honest transaction can become a flagged transaction. It is about how a harmless report can become dangerous if you try to avoid it. It is about how digital payments can produce tax forms even when people think they are just reimbursing each other. It is about how businesses now have strong incentives to report cleanly. It is about how inflation has pushed normal life into the reporting zone. Once you see the machine, you can stop being surprised by it. If you are going to move a meaningful amount of money, do not do it casually. Plan it, document it, communicate it, use the cleanest channel. Do not break it into pieces to hide from a threshold. Do not mix personal and income payments in the same digital stream. Do not assume the bank knows your purpose. Do not assume innocence prevents delay. Do not assume a report means you did something wrong. Do not assume that because a rule is old, its effect is old. That last point is critical. Old rules can become more powerful when they are connected to new technology. A rule written in an era of paper forms and local branches behaves differently when applied through databases, algorithms, digital platforms, automated alerts, and cross-referenced records. The surface rule did not need to change much. The enforcement environment changed around it. That is what makes this feel sudden, even though the underlying threshold has been sitting there for decades. For Martin and Carol, the lesson was expensive in time and stress. They still bought the car, they still had their money. But the experience taught them that their old process no longer fit the new system. After that, they changed how they handled large transactions, they communicated earlier, they documented better, they created a clearer plan with the bank, and the next transactions moved more smoothly. That is what a good decision looks like. You do not waste energy being angry at reality. You learn from reality and improve your process. The important thing is to act before the stressful moment, not during it. When you are standing at a dealership and the car may be sold, it is too late to design a banking protocol. When a contractor is waiting to start work, it is too late to learn how Form 8300 works. When a tax form arrives for payments you thought were personal, it is too late to separate the accounts cleanly for that year. When an account is frozen or questioned, it is too late to wish you had contemporaneous documentation. Preparation is cheap before the problem. It is expensive after the problem. That is one of the most reliable principles in money. If you are over 60 or if you help a parent, spouse, or relative who is over 60, take 1 hour and build the system. Now, call the bank. Ask how large senior transactions are reviewed. Ask whether they offer a trusted contact or senior authorization form. Ask what they recommend before a large withdrawal. Create a simple transaction log, separate digital payment accounts by purpose, keep documents, decide when to use wires instead of cash. Teach your family not to split payments just to stay under a threshold. None of this requires fear. It requires respect for how systems actually work. The families who will be hurt are not necessarily the dishonest families. Many dishonest people know how to navigate systems. The families who will be hurt are often the trusting families, the ones who assume that because they earn the money honestly, every institution will automatically treat every transaction smoothly. That assumption is no longer safe enough. Your money may be honest, your purpose may be normal, your history may be clean, but if the transaction looks unusual, the system may still ask questions. If the pattern looks structured, the system may still flag it. If the digital payments are mixed, the tax system may still issue a form. If the business receives a large payment, it may still file. If the threshold stays frozen, more and more of your ordinary life may continue to cross it. The answer is not to hide. The answer is to be clear. That is the difference between fear and prudence. Fear says, how do I avoid being seen? Prudence says, how do I make the truth easy to verify? That is the mindset I would use. Make the truth easy to verify. If you are buying a car, have the purchase agreement. If you are paying for a roof, have the contract and invoice. If you are helping a child, document the gift or loan clearly. If you are moving retirement funds, keep the distribution and transfer records. If you are reimbursed for personal expenses, keep the original expense records. If you are selling personal property, note what was sold and whether there was profit or loss. If you are receiving business income, keep it separate. If you are making a large withdrawal, notify the bank. If you are making a large payment, use a channel that creates a clean record. These are simple habits, but simple habits repeated early prevent complex problems later. The larger point is that financial independence is not only about accumulating assets. It is also about reducing the ways in which systems can interrupt your access to those assets at the worst moment. A person who has money but cannot move it when needed does not feel financially secure. A person who has money but cannot explain the movement of it clearly is vulnerable to unnecessary review. A person who has money but uses outdated habits in a modern compliance environment is taking a risk without being paid for it. That is not intelligent risk-taking. Intelligent risk-taking means knowing the odds, the rules, the incentives, and the consequences in this situation. The odds can be improved by preparation. The rules can be navigated by honesty and documentation. The incentives can be managed by giving banks and businesses the information they need in advance. The consequences can be reduced by avoiding patterns that look like evasion. The rules have changed in practice even if some of the words look familiar. That is why I would not treat the $10,000 rule as a simple threshold anymore. I would treat it as a signal inside a larger machine. When you cross it, the machine may produce reports. When you approach it repeatedly, the machine may look for patterns. When you move around it artificially, the machine may suspect intent. When digital platforms aggregate payments, the machine may create tax documents. When businesses face penalties, the machine may pull your information into filings. You cannot stop that machine by pretending it does not exist. But you can avoid feeding it confusing signals. That is the principle. Do not create confusing signals. Move money for real reasons. Move it in clean forms. Explain large deviations before they happen. Keep evidence. Separate categories. Avoid threshold games. Build a senior banking protocol. Then go live your life. Because the goal is not to spend your retirement afraid of your bank. The goal is to make sure that when you need your money, the system has no unnecessary reason to stand in the way. The people who understand this will not be the people trying to hide from reports. They will be the people who understand that a report is often routine, while a pattern designed to avoid a report is dangerous. They will not be the people carrying large cash withdrawals without notice. They will be the people using wires and documentation when it makes sense. They will not be the people mixing every family reimbursement, hobby sale, and side income payment into one account. They will be the people keeping categories clean. They will not be the people discovering senior transaction delays at the moment they need a cashier's check. They will be the people who called the bank before the problem. They will not be the people trying to remember details years later. They will be the people who wrote them down when the transaction happened. That is how you protect yourself in a system that is becoming broader, more automated, and more sensitive. The rules are not likely to get simpler. The threshold is not likely to suddenly reflect the purchasing power of 1970. The databases are not likely to get smaller. The algorithms are not likely to become less involved. The incentives for banks and businesses are not likely to shift toward less caution. So the rational response is not denial, it is adaptation. In history, people get into trouble when they keep using an old playbook after the environment has changed. Investors do it, governments do it, families do it, retirees do it. They assume the next period will work, like the last period. And they are surprised when the same behavior produces a different result. The environment has changed. That means the playbook must change. Before your next large transaction, do the simple things: call, document, separate, use clean payment channels, avoid artificial splitting. Ask the bank about senior transaction procedures. Put a trusted contact process in place. Keep your records organized enough that a stranger could understand them. That is not complicated, it is responsible. And it may be the difference between a transaction that moves smoothly and a transaction that is frozen, questioned, reported, delayed, or misunderstood at the exact moment you need it most. The most dangerous financial problems are often not the ones created by bad intentions. They are the ones created by good intentions moving through badly understood systems. Do not let that happen to you. You have the information now. You can build the process now. And the next time you need to move a meaningful amount of your own money, you can do it with clarity instead of surprise, with records instead of memory, and with principles instead of panic.